All right, welcome to the Multifamily Investor Nation webinar series that we do. I'm your host today, Dan Handford. I'm one of the managing partners of a group called PassiveInvesting.com. You can go to PassiveInvesting.com right here by just going to PassiveInvesting.com and finding more information about us. I'm not going to go into a lot of detail about my background because you can easily go to this Meet the Team page at the top. You just click on Meet the Team, and you can find some more information about each one of the managing partners here, as well as the rest of the team that we have assembled. We have a great solid team. We have about 45 people now that are working full-time directly with PassiveInvesting.com with our various divisions. And so it's very exciting to kind of see that group as it continues to grow. And as we continue to hire great quality people. So you can certainly find out more information there. I'm one of the managing partners here. You can click on my name here, find out more information. And there's a little video there. I'm married. I have 4 children, 3 girls and a boy, and a standard poodle named Bella. And my wife and I live and work and live here in Columbia, South Carolina. So if you're ever down in this area, feel free to reach out. Let me take you to have a cup of coffee with you, or have a nice little lunch meal or something like that with you. So we got really good sushi places here, Thai restaurants. Obviously, there's other types of restaurants too, but I'm a big kind of Thai and sushi fan, and also enjoy a nice steak here and there as well. But anyway, I digress here. Let's go back to what we're talking about. The other thing I want to mention to you is about the event we have coming up. I'm not going to go into a lot of detail here because there's a lot of information on the landing page we've created for it, but you can actually go to mfincon.com, or if you're on this page here, you can click on this MFINCon get your ticket button. It'll bring you over to here. So this is our event coming up in June 2023, June 12th, 13th, and 14th. Looking forward to meeting you there in person. We have some really cool celebrity guests that are coming in. We have Dr. Robert Cialdini, author of the book Influence, The Art of Persuasion. And then, of course, Alex Rodriguez, Major League Baseball player, as well as overall great businessman, also multifamily investor. So we're going to have him on stage. And then this third one here is actually the CEO of Taco Bell. So we've confirmed the CEO of Taco Bell is going to be there with us as well, and teaching us a lot about different leadership principles. So make sure you head over to the website, mfincon.com, find out more information there, and go ahead and get registered. And look forward to seeing you there. All right, so let's dive into the material here with explaining equity waterfall structures in apartment syndication. So first off, let's talk about what are equity waterfalls, right? So an equity waterfall is it's basically outlining how you are going to distribute cash that comes into your syndication once you have it put together. And when you think about these waterfalls, think about it like buckets stacked on top of each other. And they are, as a matter of fact, let me just do this. I'm going to pull up my whiteboard here. Let me see if I can figure out where this is, so that I have updates now. Annotation. Let's go to, looks like they did away with the whiteboard. I'm not sure where it is now. Oh, let's see. There it is. Nope, not that. Excuse me, folks. They usually have a whiteboard in here, and it looks like they've done away with my whiteboard. I don't actually see where it is anymore. Let's see. No, not there. Okay, well, I can't do the whiteboard anymore. It looks like they've done away with the whiteboard feature. Usually they have the whiteboard feature where you can actually go in and actually draw on it. So let me actually see if I can do this. Here we go. I'll just do a big old screen right here. Can you guys see this? Or just in your chat box, just let me know. Can you see this big blue box in front of this? And I'm going to change this to a different color. All right, cool. So you guys can see that. All right, so what I want you to do is I want you to think about this as buckets, okay? So you have a bucket here, and you have a bucket down here, and then they're kind of stair-stepped, right? So it's kind of like a stair, like some stairs. And what happens is whenever you have money that comes into the property, right? You have this money that comes in. What happens is that money goes into this bucket, and then once that bucket fills up with money, it overflows and fills up into the next bucket, and then it continues to fill it up, and then it falls over and flows over to the next one. That's why they call it a waterfall, because it's basically filling up buckets, and once they come to a certain hurdle, these are different, what I would call waterfall hurdles. that is basically telling you that's when it's going to go from this bucket down to that bucket. Okay, so let me erase some of this real quick and do this again with you, just so you can kind of see how this actually works. Let's see, erase here and trying to get all this special here. All right, so now what I'm going to do is I'm going to draw on here with a red pen. And the way this kind of works, let's just say we have this first bucket, and then we have the second bucket, and then we have this third bucket. The way it would work is like this first bucket would be what we call the pref bucket. So this might be, let's just say, a 7% pref. Okay, you can see I'm not very good at writing with my mouse, but we have a 7% pref here. And this 7% pref, 100% of the cash, right? 100% of that cash is going to go into this first bucket until the investors receive that 7% pref. Okay. Then once they receive that 7% pref, then the rest of the cash that's left over is going to fall into this bucket. And this bucket, like for example, in some of our projects that we put together, we actually have a hurdle that once the investors get a certain return, then things can split differently, right? And so once we hit this 7% pref, we now hit this kind of bucket that we would call the 70-30 bucket. 70% of the cash is going to go to the investors on the LP side, and then the 30% is going to go to us as the GP on the GP side. And now once that bucket fills all the way up, then the rest of the cash is going to go into this bucket. And then this bucket, the hurdle here, of course, up here is the 7% pref, right? The hurdle here, we might set as, say, like in our group, we usually do like a 13 IRR, right? So once you have a 13 IRR, then that bucket will stop filling up and it'll go down to the next bucket. And this bucket, for like the situation that we usually do, we'll usually split 50-50 after a 13 IRR. So then the rest of the bucket, then there's no buckets after that. So this is just like an infinite bucket until you run out of cash, right? And so that's a typical waterfall structure. But I wanted to show you that so you can kind of see what a actual equity waterfall looks like. So you can see, okay, as cash comes in, what happens to it? Where does it go? How does it fill up each one of these buckets? And how does it go down to the next bucket? And where are those hurdles? So this is really a good way for you to understand equity waterfalls and the equity hurdles within a waterfall. So the waterfall itself is this entire thing, but the hurdles are these little pieces here, right? Those are what they would call hurdles. So once the cash gets up to that certain point, it jumps over that hurdle and goes down to the next bucket. Okay, so hopefully that was helpful for you to kind of understand and kind of figure out exactly how that actually works. And it is not, you don't necessarily have to do it exactly the way we do it, but I wanted to share with you kind of how we do things and how that actually works with some of the projects that we are putting together, because we do have quite a long track record of being able to put projects together. We currently right now have acquired right at about 1.7 billion in assets since 2018. We have accepted no institutional money at all. We have sold a few deals, and we're sitting right at about probably 1.3 to 1.4 billion in assets under management right now. We started in 2018 raising about $4 million in 2018. In 2019, we raised $32 million. In 2020, we raised $61 million. Last year in 2021, we raised $196 million. And this year, we will be closing out this year right at about $290 million raised just this year alone. So up to this point, we've raised just over $500 million in equity from our investors using these specific types of waterfalls. And so if you want to kind of set yourself up for success, copy what we're doing. That's why we have these webinars, so you can see exactly how we're doing things, what we're doing, how we're structuring them. Okay. So let me explain to you kind of the three most common types of equity waterfalls. This kind of goes back to this next question that we have down here, right? These three most common types of equity waterfall structures. And so let me actually do this. I'm going to go to our website, passiveinvesting.com, and you can do this as well if you'd like. If you just go to passiveinvesting.com, on the top menu bar here, if you click on the word Knowledge Center, it'll pull up our list of articles that we have written. And one of them is around waterfalls. I'm just going to type in waterfall in here. And again, you can do the same thing. I'm going to click on the first picture here, and you can see that these are the three waterfalls, right? So we have the cash flow waterfall, we have the refinance waterfall, and then we also have the sale promote waterfall. So all of these waterfalls are typically included in an actual syndication. So if you ever have invested in a syndication or you've put one together, there are typically 3 different types of waterfalls. Now, some people lump the refinance waterfall with a sale waterfall, which is perfectly fine. But if you wanted to break it down and break it out into 3 different waterfalls, you certainly can. But the cash flow waterfall is basically just like it says, right? So all of the cash during the hold period that comes in from people paying their rent, and you've paid all your expenses and your debt service, whatever's left over, that cash is going to go into this cash flow waterfall, and it's going to be able to allow you to kind of figure out how that cash is going to flow during the hold period as you're distributing it out to the investors, right? And as you're distributing it out to yourself as the operator, if you're putting these things together yourself. Now, the second one, of course, is this refinance waterfall. The refinance waterfall is saying, okay, I've been in this, I've operated this deal for, say, 2 years, 3 years. I've now done a refinance. I have this, $1 million that I need to pull, that I've now pulled out of the asset. How am I going to distribute that $1 million cash flow from the refinance to the investors, right? So that would be that refinance waterfall. The sale promote waterfall is on the back end when we sell. Once you sell the asset, that sale promote waterfall is how you're going to distribute the cash once you've actually sold the asset. It's basically telling the investors how you're going to just divvy up those sale proceeds and distribute them once the asset is actually completely sold on the back end. So those are the 3 main ones, and these should all be listed out and outlined. Usually they do it in kind of bullet form. Sometimes you'll see it in paragraph form, but it's very clean if you can do it in a bullet form that says, all right, we have cash coming in. We're going to pay this first, and then we're going to pay this, and then we're going to pay this up to this hurdle, and then we're going to pay this up to this hurdle, and then whatever's left over is just going to continue to go be split, 70, 30, 50, 50, whatever that waterfall is explaining to, is outlining, if you will. Okay. So I want to show you one. Well, the reason I pulled this article up because I wanted to show you this first one. So this is kind of those buckets that I mentioned to you earlier. But in this figure, you can see the first bucket is the LP, 100% of the cash flows. And again, if you look up here, this is the cash flow waterfall, right? So during the hold period, this is what's going to happen to the cash in this particular example. 100% of the cash is going to come into this first bucket, and it's going to, let me actually pull my little annotator up here so I can be drawing on this while I'm doing it. That's always fun. All right, so again, so we talked about right now we're talking, I don't like that long. There we go. All right, so right now we're talking about this waterfall right here, right? Or this hurdle, excuse me, this bucket in the waterfall, which is the first bucket. So 100% of the cash flow that comes in is going to go into this first bucket, and up to that 7% preferred return. So once all the investors get 100% of the cash flow up to that 7% preferred return, that's where this next arrow is going to come in, and the rest of that cash is going to go to this next bucket, where then this next bucket is going to be 70-30. This is the exact example that I showed you earlier when I was drawing it out. Once that bucket fills up, let's just say the hurdle right here is going to be that 13% IRR, then it's going to stop filling up this bucket, and it's going to go into the next bucket, right? And once it hits this bucket, it's going to be a 50-50 split until there's no more cash left, right? So that's an example of the cash flow waterfalls, if you will. Now, let me kind of show you the next kind of waterfall that we have here. And let's see here. This next one is going to be, of course, the refinance waterfall, right? So the refinance waterfall, you can see here on the screen, pull my little annotator up here again. You can see on this first bucket, right? Same thing, 100% of the cash is going to go into this bucket up to the 7% preferred return. And then it's going to go into this next bucket, and then the hurdle on this particular bucket, or in this particular example, because it's a refinance waterfall, we're going to return all the initial capital or investment to the investors. And so we're going to put all the cash into this bucket until we've returned all of the cash to investors, and then it's going to fall over to the next bucket, right? And this is where that 70-30 split is, goes to that 13 IRR and comes down and goes to 50-50. Right. And so what you can see from here is the GP doesn't make any money. The operator makes no money until we make sure that the investors receive their 7% preferred return and they get their capital back. right? So we want to make sure we protect our investors, right? So when we get into this business of syndication, one of the most challenging things that I see people do, or frustrating things I see people do, is they try to structure their waterfall to primarily benefit them as the operator and the GP. And guess what? That's the wrong way to be doing things. That's the wrong thing to be the way to be thinking. If you want to be in this business and be into it for the long haul and the long term, you have to make sure that you set up these types of waterfalls and structures to benefit your investors. Because at the end of the day, we want to make sure that we have this business, we have these investors, not just for one deal, not just for two deals, but for multiple deals over a generation and over a lifetime, right? We want to make sure that we can create generational wealth with our investors as well as ourselves. We can make a nice, healthy profit and still provide great quality returns for our investors and protect them and their downside risks as much as possible. And that's what you're seeing here in this refinance waterfall, where we're giving away that we're going to give them that 7% preferred return. We're going to give them all their capital back before we, as the operator, see anything from the deal itself. Now, I say we don't see anything. Now, obviously, we're still making fees on the front end. And if you put it into your underwriting and you want to do a refinance fee, you can certainly do that. Our group, we don't actually do a refinance fee. We just have that as an actual added value, but for the investors, that's what we actually do for them. All right. Let me see if I can go out of this real quick. I'm going to scroll down to this last one here. This one is called the sale promote waterfall. Okay. And so this one is going to be very similar to the refinance waterfall, as you can see, right? This is why I say sometimes these two are lumped together as hey, this is what happens on a refinance or a sale promote, right? Sometimes though, in the refinance waterfall, if you have different classes of investors, one of the investors you might cash out and the other investors you might not cash out. To give you an example, if you do a refinance and you have a class of shares where it's really more of a preferred equity slice, where they're getting a 10% preferred return, but no upside participation, those investors on a refinance don't really want to get paid their money back, right? Because they want to make sure they can continue to make and earn that 10%. Because once you liquidate that investor out, they really aren't getting anything, because you've now their preferred return is based off of their unreturned capital contributions, right? And again, I'm not going to get into the whole unreturned capital contributions and stuff like that. However, if you go to our knowledge center on our website at passiveinvesting.com, you type in capital contribution or unreturned capital or whatever, you'll find another article that I wrote specifically on how those preferred returns are calculated, the unreturned capital contributions, and all of those types of explanations around that. So that'd be a great resource for you to go there and actually kind of get some of those questions answered through some of those articles. All right. Now, the question here is which equity waterfall should you use in your next deal? I would say you should be using all three of them, right? There's not just one that you should use. And it's okay if you lump them together. Like if you only have one class of shares, having two equity waterfalls, the cash flow waterfall, and then you might even call it a capital event waterfall. So that would lump in both your refinance capital event and your sale promote or your sale capital event, right? So I've seen it labeled that way as well. All right, so let me go ahead and open it up for some questions and answers here. I see there are a few questions here into the chat, into the Q&A box. I will put this in here. All right, let's see. Somebody is asking, is the admission to the MFI Incon free? No, it is not. So the MFI Incon is actually a premium and very premier multifamily event around in the country, right? One of the things we saw is that there was a little bit of a lack of really great quality, high quality people, high quality venue and speakers coming to an event. And so we wanted to make sure we changed that. And so that's what this event is. It's a very high quality event. It costs a lot of money for us to put this thing on. As a matter of fact, it cost us, 7 figures to put this event together last year. The way we put together. So we don't skimp, right? And our goal is not just to make a bunch of money on this event. The goal is to provide a lot of great quality content and provide some great quality connections with other people just like you that want to play at a very high level. So if you want to play this game of multifamily investing and be an operator and do your own syndications, This is an event that you must attend. You're going to be able to rub shoulders with some of the most premier people in the industry, especially with some of these, even with some of these guest speakers that we have as well. A good question there. The other question came in was, what was the book that I recommended earlier? The book that I recommended for you was by Robert Cialdini, Dr. Robert Cialdini. And if you look on your screen here, this is the gentleman right here, Dr. Robert Cialdini. He is the one who wrote the book Influence. And if you click on it, the actual picture, you'll see the information about him with this book. Looks like I got an extra thing I forgot to erase here. There we go. Little hidden line there. So it says, and then this next link, this next thing here says the MFIN con was not working. It's probably because I put in a S into it. Maybe that's what it is. Yes. So just take out the S, or you can go to this link here. If you just go to mfincon.com, it'll bring you there for those of you who are watching the recording. For those of you who are joining us live, I'll type into the chat box the proper link for you so you have that as well. And you can go straight over there to find more information, register for this event. All right, let's see. FYI, chat is disabled. Yes, so most of the questions we wanted to have is in here. And yes, Joe, usually I have the chat open. For some reason, it's off today. It probably had something to do with the update on Zoom. I do apologize for that. So if you do have some questions, make sure you push that into, make sure you go ahead and push that into the Q&A box that we have available for you too. All right, so the question from Joe is the pref percentage always an IRR? Most pitch decks, I don't think, clarify. So if the pitch decks don't clarify it, it should be clarified in the PPM because it has to be outlined so that the investors know exactly what you're basing it off of. Most people will base it off of the IRR, but some people will base it off of other things. I've seen waterfalls that have hurdles in it that base it off of an equity multiple, right? So once you hit a certain equity multiple, it triggers the next bucket. I've seen them do it on the annualized return. Once it hits that annualized return, it triggers that hurdle, goes to the next bucket, right? So you can, that's the nice thing about this kind of these types of structures is that you can choose to structure it however you want. But again, it goes back to, are you making sure that you're setting this up for success for your investors? Because if you can do that and you can match and marry the success for investors with you getting a nice return as well, it's a win-win, right? All right, next question Joe has is, when I get some capital back from a refi, does my pref calculation adjust reflective of the remaining capital in the project? Yes, it does. It's a great thing to bring up here. So your preferred return is always calculated based off of the unreturned capital contribution. So what that means is if you invested $100,000 and you were getting a 7% preferred return, and so you're getting $7,000 a year, right? That's you might not be getting it, but that's the preferred return, right? And again, I can talk on preferred returns for a little while too, which I don't want to get into that rabbit trail, but let's just keep the math simple. $100,000 investment, you're getting $7,000 a year for this preferred return. And then you do a refinance, right? The refinance returns 50% of your capital. So now, instead of $100,000 invested, you now have $50,000 invested. Now your preferred return is $50,000 times the 7%, which is $3,500 a year, right? And so when you're doing a refinance and you're doing your underwriting, you do reduce that preferred return to the investors because you are returning that capital back to investors. Brian's asking about the recording. Yes, we will send out the recording after this. So if you register for this, you will get that recording. Frenchie's saying, when you say return the money to investors at each bucket, do you mean their total investment or agreed upon amount at each hurdle? So this is dependent upon the actual position in the waterfall, right? So you saw in some of them, we're not returning their capital, we're giving them a return on their investment. And then when there's a refinance or a sale, we're returning their capital back and then giving them more return after that so they can get their higher return off of their investment. So it really just depends on where you are in that waterfall as to which bucket or whether you're giving money back to the investors or you're giving them a return. All right, so Martin says, so can you have a cash flow waterfall and a refi waterfall in the same deal? Yes, so these waterfalls should be in every single one of your deals. So every deal we put together, there's 3 waterfalls. There's the cash flow waterfall, basically telling us cash flow that's coming into the deal, how am I going to distribute that? And then when I have a refinance in that same deal, what's going to happen in that waterfall? right, with that money. And then, of course, in that same deal, when you sell it, there's another waterfall that says, what am I going to do to distribute that capital when that money comes in? And so it's different each time based on the actual waterfall that you put together. Jonathan's asking, since a 7% pref would have to include the return of capital, isn't the second bucket, return of capital, redundant? No, that's not correct at all. So giving a preferred return has nothing to do with return of capital. So that's basically just giving them a return on their capital, right? And so if I put in $100,000 and I'm getting 7% a year or whatever, right? So let's just say I'm getting that, just make the math simple. The deal's doing great. I'm getting $7,000 a year. My investment amount is not return of capital. My amount's going down every year, right? You want to make sure that when you're distributing it, it says a return on capital, right? And so they're getting a return on their capital. And then once you hit that one bucket in the sale or the refinance where you're returning their capital, that's the return of capital on those waterfalls. All right, Brian's asking, are you still looking for sponsors for the MFI Con? Yes, we are. So if you want to shoot an email over to Hannah, you can email her at HANNAH, Hannah@passiveinvesting.com, and she can shoot you over the sponsorship details. So you can take a look at that as well. We do still have some opportunities available for sponsorships. All right, I got a few more questions here. I got someone asking me or saying down here, you have a lot of distortion on your microphone. I do apologize because I'm actually not at my home office doing this webinar. So I do apologize. Hopefully you guys were able to hear as much of it as you could, but to get the information. But I do apologize that I don't have the best quality microphone like I normally do. I'm doing this off of my laptop and I'm kind of away from the office right now. So I do apologize for that. I got two last questions in here and then we'll go ahead and wrap it up for the day. What are your company's target acquisition goals for 2023? Is your financial modeling more conservative based on the current market rate conditions? I will say yes and yes. So like it's very hard right now to really figure out what we're going to do for 2023 because we don't know what's going to happen. But I will tell you this, that this year we acquired just over $400 million in multifamily assets. Our group does not acquire just multifamily, we acquire self-storage, we acquire hotels, we acquire express car washes. We also have a debt fund. Then we're also launching an additional asset class next year that nobody's even doing right now, which is going to be really cool. More details to follow on that. But I will say that I believe that one of the things we're already seeing is people who have bought deals a year, 2 years, 3 years ago are getting caught with their pants down because they were not conservative in their underwriting. They didn't raise enough operating reserves and operating capital. And so they're doing capital calls right now. Lenders are getting to the point where they're not wanting to lend on certain assets because the DSCRs are too low. And so people are cutting proceeds on refinances for bridge debt that's coming due. And so we're going to see some deals, I think, in Q1 and Q2 of next year that are going to be it's going to be frustrating for some investors because there's going to be some investors that are in some projects that I hope they don't lose money, but they're not going to make the return they expected because they're going to have to sell the deal, even though they just might have bought it a year or 2 years ago, because they just can't afford the debt anymore because they bought a floating rate. And some of these people didn't buy interest rate caps, which is a big no-no. You always should buy an interest rate cap if you have a floating rate because you never know when something like this happens, and then you can't afford the debt service. If you can't afford the debt service, the bank takes the property over, it gets foreclosed on, and it gets put on the market, and another group can actually buy it and perform it very well. But we're already seeing some of that now with some of these deals that are coming out, and I think we're going to see some more of that. I'm confident that we're going to see some more of that coming up, and even in January and February, we're going to see some more of that. All right, last question here is from Jonathan. When you make distributions, do you make them as return of capital or return on capital? So that's a very good distinction. We actually, when we do distributions from the cash flow distributions, they are return on capital, right? And the reason why that's important is because we want to make sure that we're not reducing the investor's capital balance, so it's reducing their preferred return over time. Again, we want to make sure we're protecting our investors. So when we make these distributions from the cash flows, it is a return on capital. Now, from a tax perspective, that's different. From a tax perspective, it's classified as a return of capital. But for waterfall calculation purposes, it's return on capital. And I know I might have just completely confused everybody by saying what I just said, but if you go to our website, passiveinvesting.com, I've written some articles on that between both return of capital versus return on capital. We've also done some videos on those different concepts. So it's definitely something you really want to make sure you understand, especially from an LP's perspective, to make sure that you don't invest in a project unless they're doing it the right way, which is giving you your distributions as return on your capital, but then also from a tax perspective, giving it to you as return of capital. And then, of course, when you do any type of refinance or sale, that's when you get that return, that return of capital based on the waterfalls. All right, so that's all I have for today. Make sure you go over to mfincon at mfincon.com and register for the webinar today. Let me refresh my screen here so you can see what's coming up next week. So next week we have Chris Neary. He's our Senior Acquisitions Associate here at PassiveInvesting.com. He is going to be talking about the final steps in the multifamily acquisitions process. So make sure you go head over to multifamilyinvestornation.com and register for that next webinar. And we look forward to seeing you there. One last thing I'll mention is about our podcast. Don't forget about the podcast. We have our podcast, which you can click on the link here for. It's on Apple, iTunes, and all other podcast platforms, or Android and Google and all that kind of stuff. It's called Multifamily Investor Nation. And what we do is we dive deep into different projects and different deals that real people are acquiring and closing in the current market. And so we dive deep into that and explain to them exactly what's happening, or we get them to explain to us how it exactly happened, from how they found the deal, how they were able to put the offers on it, due diligence, term sheets, and returns, and what's the business plan from a renovations perspective, and all the way down to the closing table from the financing and working with investors. So we spend usually about 30-45 minutes going deep into these different projects that different people around the country are putting together. And we do not interview any gurus or high-level people unless they've closed a multifamily deal in the last 12 months. So if you yourself have closed a deal in the last 12 months, reach out to us. We want to have you on the podcast as well. So thank you so much for being here, and look forward to having you guys back next week. And also look forward to meeting you guys in June at the MFINCon, which is coming up in Charlotte, North Carolina in June 2020 and 2023. So thank you so much, and hope you guys have a good rest of your day.